20. My point is anything over 272 is what matters. At the end of the day, if you have to form a government, you have to run a government, you have to make policy, you need 273. So during an election, political sloganeering is a whole different kettle of fish, right? Yeah. You say 400, you can say anything actually, because that's part of campaigning. At the end of the day, is there any real data or concern about whether you're going to have an upset? We don't know.
Yeah.
3 phases of polls, so we don't know yet. But nothing really has changed on ground except a lower voter turnout, which could be for various reasons. And of course, we'll talk about that more ahead on the show.
Yeah, and I think it's everything else that's coming together as well, right? The fact remains that earnings were not very impressive, to say the least. I mean, no one's super excited about it. India still is an expensive market. China's trade seems to be back on. The VIX has seen some rising, and historically, while the outcome on the election is almost a given, FIIs historically prefer buying at a premium post an outcome as opposed to preempting an outcome. And that's what's playing out. And we've talked about this at length. And let's not forget the Nifty is priced to perfection. So any sort of negative news flow is going to disappoint the street. And that really is what's playing out. So it's nothing to be worried about, but there has been basket broad-based selling. The VIX is up over 30% in the last 4 days. And let's not forget, in the preceding month, we saw the VIX decline substantially, historical declines ever in the first week of May. And now we are seeing an historical rise on the VIX. So it's wild swings, but I think that's par for the course.
Yeah. So we'll break that down in more detail ahead in the show. But let's start with the global setup this morning and how that side of things is working out. So our 5-day winning streak continued pretty much on Wall Street, at least for the Dow. No massive gains, but in closing in the green, so in positive territory. The focus continues to be on corporate results coming in, the jobs data last week, still giving some hope to the markets that you would see Fed cuts at least this year. It's a scale right now. If you're very, very optimistic as a Wall Street investor, you're looking at possibly 2 Fed cuts this year. If you're negative, then you're like Neil Kashkari, the Minneapolis Fed chief, who's saying that maybe not this year at all. And if you want the Goldilocks scenario, not too hot, not too cold, you're looking at possibly a December. So that's the large, broad sentiment in the U.S. markets. And Neil Kashkari, important comment from him. He's usually hawkish, and he said that rates may have to be kept steady for longer. So that's a cue that will be taken as well. Bond yields, on the other hand, continue to remain okay at 4.53. On rate cut hopes. But remember, it had dipped below 4.5 as well. So no big movement there. Neither on crude, to be honest. It's a wait and watch, because there was an attempt at a ceasefire. Hamas accepted one version. Israel has rejected it, continues its operations in Rafah. So no clarity if anything is happening there. So largely unchanged on the WTI and the Brent. No big moves on crude that have been seen. Asia, meanwhile, has a mixed kind of an opening. Following cues globally. So suffice to say, no clear direction coming in globally either. Just want to get to the implied open and just set up what you're going to see today perhaps, and there you have it, maybe positive, slightly up in the green.
Yeah. One thing that I have been thinking, both of you will agree, and this is the wild swing when we talk about the Fed, right? We talk about a Goldilocks scenario, and in the same breath, you have analysts talking about stagflation. Both of them are extreme ends of the spectrum. There are people talking about a rate cut, there are people talking about a rate hike. It's almost tough to read into what the median really stands at. And looking at Asia, and I think that was an interesting reading, see the way Japan is falling again this morning, and see the way Hong Kong is actually rising. So what we found interesting is that it could be that China trade is back on. Hong Kong has seen its biggest winning streak since 2018. And this comes in at a time when Chinese markets have been closed. So what this means is that it's foreign investors that have been aggressively buying into China. We've talked about how this is not going to have a huge impact on Indian flows, but will definitely eat into the piece of the pie from Japan. Remember, FIIs were flocking into Japan and Taiwan for the love of semiconductors. That has been seen weaning off after a few disappointing earnings that came in from Japan, and that led to a massive sell-off across those markets. So what your foreign inflow was really doing is dumping Japan, moving the diversification into markets like China and Hong Kong. The other thing that we also did realize is that after Japanese yen has declined very sharply, the returns for 1 year for US dominated ETFs or Japanese funds is only up 8% versus the market in local currency being up 14%. So lots of negatives playing out for Japan, which seems to be China's gain in a big way. The People's Bank of China has come in with a huge stimulus package. We've talked about this extensively over the last couple of days and weeks, actually. They're looking to boost their real estate market. They've talked about shanty redevelopment, urban village development. All those factors is what's actually boosting inflows coming into China. Also, what we noticed was the money coming into China right now is sticky money. It's mutual fund money as opposed to easy money that's flowing into those markets. For what we can see, Niraj, Tamanna, both of you please weigh in, is that this is eating into China, eating into Japan's inflows. What it's doing to India, tough to tell at this stage, but historically, India's always given a piece of the pie when China starts looking good. While these markets are mutually exclusive of each other, I'm not sure whether that may continue for the foreseeable future, at least in the interim, given where we stand as well, right?
I think the delinking has begun and will continue, where assessments of India will be made independently. Also, think of it this way: everyone wants to sort of, balance your risks, and India is a different trajectory and a different story, which I think time and again now has been proven over the last few years. So I don't know if it's going to be so much of an either or. At least that's my take.
No, not too much.
No, nobody discussed this in the US, is it?
No. Everybody's talking about how inflation is unlikely to come down. Just look at the wage rates and the consumer spending, and it's something else out there. But anyways, let's move on. It's 8:07. A quick trade setup and then the stocks to watch in this session today. So for the day, I think Samina's kind of highlighted the volatility issue as well. But India VIX up for 9 straight sessions at the highest level since 2023. Tells you what's happening in the market, really. And it's very difficult to shrug off this volatility, I presume, until the opinion polls are out. Frankly, who is to come and say that, oh, this cannot be there and this can be? The market will think what it wants to think, to be very honest. What we can talk about is data, right? And Sensex revenue and earnings growth thus far, as of yesterday evening, is at 10% and 12%, which is marginally higher than what was estimated. Actually, on the earnings PAT growth, much higher than what was estimated. So that is actually a positive, if you will. The two things that stood out, and one, yesterday SRF was symptomatic of what's happening in the chemical space. The PAT performance has been wobbly, and the commentary still clouded. I think we'll talk about Navin Fluorine as well in a bit. But I think there is an issue out there that while there was some bottom fishing happening, thinking that China reviving will help chemicals, I think the commentary thus far is looking very clouded. And lastly, metals. The Morgan Stanley note on steel today was outstanding, wherein they are, standing out, wherein they are saying that the current valuations at 1.8 times price to book versus long-term averages of 1 time look unattractive, and this space could derate over the coming months simply because there is just no material improvement in inventory levels and spreads. So while everybody's been rah-rah over China uptake and what it could do to metals, clearly inventory levels don't show, spreads don't show that, but valuations show that. I have a clear case of asking a question whether valuation should come off. So that's an interesting bucket to my mind.
Yeah, well, that's largely what we're expecting today as well. Could be another morning where the street will consolidate the negative bias. It's tough to call these things. But yeah, you could see some low-level buying, but the fact remains there is nervousness, jitters, whatever you want to call it, on D Street, and extremely volatile trade that we are setting ourselves up for. Nothing out of the ordinary. That's the other thing you want to be mindful of. A few stocks that are on my radar this morning that we'll quickly highlight for you. JSW Energy reported numbers. Those numbers on the face of it look pretty phenomenal, actually, to say the least. The margins have improved to about 43%. 23% versus 28% the same quarter last year. Revenues were up slightly, flat to slightly up, about 3.2%. EBITDA was up 58% to come at 1,178 crores versus 745. And their profits were also up about 22.5%. Mixed views coming in from brokerages. So while you had Citi that maintains a sell on JSW Energy, they've raised the target price to 435, which is a 25% downside. Jefferies, on the other hand, continues with a buy on JSW Energy, and they've raised the target to 690. Citi, of course, says that they maintain a sell on higher valuations, and also have concern, the fact that they want to watch out for is execution and whether or not the new order wins could, of course, come in at lower margins. So they bid very aggressively. That may impact the very healthy looking margins at this stage. So JSW is one you want to watch out for. Pidilite and United Breweries, good set of numbers from both of them. For Pidilite, revenues were up nearly 8% at 2,902 crores. EBITDA was up 25.6%. Margins have also improved to nearly 20% on the upper band of what we've seen for Pidilite versus 17%. Net profits was up marginally. So this one could be one you want to track in morning trade. Not too many brokerages commenting on it just yet, but of course that will flow in as we go along through the day. United Breweries, again, I'd love to know what's going on, and we'll talk to the management on back of these numbers, but the revenues were up 18%. EBITDA was up 166%. I'm guessing that was an exceptional item on that one at 143 crores versus 54 crores. Margins have also improved substantially to come in at 6.7% versus 3%, and net profit was up 730%. So very obviously at 81 crores versus 9.87 crores. So it could be outside core business that's pushed up the earnings for United Breweries. The management will be talking to us at 10:30 a.m. and we will get a sense of what led to such a good reporting from them this quarter.
Yeah. I just want to start, and of course we'll get to some of the results coming in, but I just want to start by putting the focus on the set of consumer companies that have been the star of the show the last two trading sessions of this week, Monday and Tuesday at least. And what would be interesting to watch is if that holds up. So if it was a Britannia leading the pack on a Monday, it was HUL on Tuesday. Among the Nifty companies, Marico, Godrej Consumer, that entire set. Now, quite a few notes this morning talking about how the hope is that volume growth will come in, and Q4, the end of Q4, is seeing an improvement in rural demand. Nielsen data also out yesterday talks about an uptick in rural demand. The question is that is this merely a rotational play, or will you see now a sustained turnaround in a set of companies that have been described by one expert we spoke to as unloved? So FMCG companies is one that I would definitely watch, and you might see some interesting moves over there, perhaps a pullback in some of those stocks as well. The other one, of course, is Dr. Reddy's. Numbers out, and numbers slightly below expectations, I would say. Now, I was just looking at Nuvama's note on it, and their concern is that the core business EBITDA margin is below 20%. At 17% actually, if you remove G rev limit, and the concerns of that start in 2027. So there's a decline of about 250 to 300 bips there. The R&D spends at 10% of sales long term is of course a good thing, but they expect that to continue at a higher level at least till FY27. So it might impact revenues there as well. It's all towards a new suite of drugs called Horizon. So we'll have to wait and see how that turns up. But that is going to be an impact. So Nuvama has maintained a reduce and a target price at 6,258, which is pretty much where the stock is right now. So is there really an upside? Could you see a bit of pressure in Dr. Reddy's this morning? It's possible you do. Navin Fluorine is the other one. Niraj referred to it briefly. So as expected, revenues down, EBITDA down 45% year on year, margins are down, so are net profits. Now the whole question about this space is what is the outlook for improvement? And management commentary so far is looking at a gradual agrochemical recovery in FY25, but more pain may be in store for this space. And that's a point that you made, Niraj, that the light is not yet visible at the end of that tunnel. It's there, but it's not yet visible.
Yeah, and for Navin particularly, I mean, CDMO is now a big part of their business. That number in Q4 was only 48 crores versus 208 crores YOY. So you know where the pain came in. You heard Loris and Sinjin speak about how CDMO is only coming back in the second half. So Navin, very unlikely to see that. And for Navin in particular, the other issue has been they're not having a managing director. And thus far, they're saying that they're hopeful of onboarding a new MD soon, but no clarity on when that comes in and what the strategy of the new MD will be. So in some sense, a ship without the captain at its helm, a bit of a problem.
You know, one small segue, but one recurring theme in this entire results season, I think at least I have noticed, is that the captain of the ship has become very, very important. Whether it's a tech company or you know any sort of sector or a bank, what an Ashok Vaswani says or what a Mohit Joshi says makes a huge difference to the market, and may even supersede what numbers you're presenting in Q4 because the outline is clear. So if there is no captain, rudderless always
case in point.
has a
I
problem.
think it's historically, when a fund manager, when you bet on a company, qualitative analysis, I think one of the top factors is the founder or the promoter.
Yeah.
So that
or the CXO in this case.
becoming very, very evident now because there have been changes on that front recently.
IGL was the other one I just wanted to talk about, third stock, before I handed off to Niraj for his first cut of his list. So IGL, again, not very, very great numbers. The Q4 EBITDA at 12% is below brokerage estimates. Those base numbers on your screen. The OPEX has been higher. Volume mix has also been higher, not too great. It's led to lower margins. The industrial volumes are in line with estimates, and there is a partial impact of CNG prices that was felt in Q4, so that will be taken into account. I would assume you won't have a very great opening for Indraprastha Gas, but then it's a wait and watch to see what you're going to see. The one outcome from the management which caught my attention is that they're going to venture into the EV charging segment, but then that is one of those plans that we'll have to see actually play out before coming into any conclusion.
Yeah, well, so watch out for these three. 2 or 3 stocks, PB Fintech, and the con call is on right now, so what they say in the con call will probably supersede what they've reported, but total income up 23%. PAT up 62% YOY, but the point being it is exactly in line with what was estimated. So this total income, but the PAT at 60 crores, the Bloomberg estimate was 60.4 crores. We missed that, but the relative to what was estimated, they have reported just the exact number. The adjusted EBITDA margin is up 370 basis points, which is at new highs for PB Fintech. So they actually really did well. And the core business beat was largely led by strong insurance, new business growth. This is something that is welcome. So very likely that the stock will do well, but we'll wait for the takeaways from the con call before things get decided. And the con call is on, as I said, so that might supersede the reported numbers. Sonata left a bit to be desired. Revenues were down 12% at 2192 crores. The Bloomberg estimate was 2178 crores. So that in line, but EBIT margin at 5.03%. The estimates were 7.73%. PAT down 22% at 33 crores. The estimates was a very high number. Very likely Sonata Software could see a bit of a reaction downwards. And, Voltas is the other one, guys. The stock, along with all the cooling solution companies, saw a lot of fanfare in the build-up to the results, has had a really good rally in the last 1 month. The numbers on all counts was a bit of a miss. Brokerages are still constructive here, but the numbers are a miss in a wobbly market. Maybe you see a reaction. If you see a reaction, you know why that is happening.
Yeah, and also the massive run-up that it's already seen on the back of a hot summer, etc., etc. But it's not necessary that you are going to benefit as much as your other competitors in a hot summer, I suppose. That's the story for Voltas.
Yeah, we've got a bunch of other stocks, but I think we're clearly out of time. A quick mention on numbers. IRB Infra reported earnings that were slightly disappointing. Max Financial has also posted a huge loss of 50 crores versus a profit of 52 crores. So watch out for these ones. ILP and Max should be on your radar on the downside. Jindal Store, on the other hand, saw a good set of earnings. So they've seen a good margin expansion. Their revenues are up. EBITDA is up quite sharply. And profits were also up 62%. So Max and ILP on the downside. And you've got Jindal Store on the upside. That looks good.
I just wanted to talk about Jupiter Wagons for a second. Numbers look good. your revenues up 57%, your EBITDA is showing a healthy uptick, 60%, margins also decent, 13.2% versus a 12.9%, and profits up 167%. Now again, this is one of those spaces which will see perhaps a renewed interest once you have elections out of the way. The whole plan or the policy push for a complete overhaul of Indian Railways is a long-term one. It's not about 1, 2, 3 years, probably go on to the next decade. So Jupiter Wagons one to look out for. But the numbers at least don't leave anything to be too disappointed at this point. V was the other one. So Nuvama has maintained a hold. Citi had an interesting line to the effect that stars may be finally aligning for Vodafone Idea, and this is post a management meet with some analysts. Now, Citi is looking at a possible 15 rupee scenario for Vodafone based on two core things. One is that the ARPUs go up significantly, nearly by 60% in the next couple of years, that you would have those tariffs going up. And that's something the whole industry is betting on, clearly. And the second big one is that one of its large stakeholders, which is the government of India, continues to be quite benign. When their dues come through, the AGR dues come through, at least part of it gets converted to equity. So that's the push. You might see some movement on a Vodafone Idea this morning.
There's Dixon as well, by the way. I don't know if the Nokia announcement helps Dixon, so that's to be watched out for. And two brokerage notes which I thought stood out. One was, Samina was speaking about JSW Energy. The Jeffries note on JSW Energy is interesting. They have a buy call. The target price raised to 690 versus 600 earlier. And the reason they say is that the power demand recovery to 7% plus levels points to peak deficit pockets continuing, which might keep double-digit earnings growth visibility for JSW in the medium term. They have raised their FY25 and 26 EBITDA by nearly 10% apiece for both of those years, which is actually pretty strong to my mind. And the Morgan Stanley note on Concord, the only caveat is that at 3 p.m. yesterday, some people put out on social media that Morgan Stanley's target is much higher than the current price. So in some sense, yesterday's, maybe there would have been a bit of a move, but substantially high target price by Morgan Stanley on Concord because of freight rates.
Just so quickly on JSW, and I don't know if you've seen it, those margins, how sustainable are that? 42% versus 28% in the same quarter last year. So I'm not sure if they go out and aggressively continue to bid, those margins will be compromised. No, and so how have they managed to pull it off?
Merchant rates currently are going through the roof because of power deficit, and everybody who's got a little bit of merchant power sale, which JSW does, is actually benefiting quite a bit. So maybe not as much for a Tata Power, which is largely PPA, but everybody with a little bit of merchant power angle is doing really well.
A great day in trade, but yeah.
All right, so let's talk about the elephant in the room, which is what is bothering markets. Now, this is a tricky one because there's no real way of knowing one way or the other, so it's always a guessing game. But going by all of the social media chatter yesterday, it's a couple of factors. One is FII flows, and Samina, like you were talking about, that before June 4th, they might be sitting on the sidelines. You're not going to see some of that money coming in. And on the other hand, the voter turnout figures have also bothered the market. So I'm just going to start by what was the voter turnout and why it is becoming a concern at all. So let's just pull that up. 3 phases of the election has been done. So nearly 50% of the election is pretty much over. Bulk of the seats are already done. Now, in all the 3 phases, you've had a voter turnout lesser than 2019. Now, just to qualify it, and at a point my colleague Sajid Mangat was making in the newsroom, it's on an absolute figure. Remember, every 5 years, your number of voters goes up because the population increases and the number of eligible voters go up. So in absolute terms, there will always be more people voting, even though the percentage of those who actually turn up might be lower. So having said that, in phase 1, you had a 63% voter turnout versus a 70% in 2019. In phase 2, it was 61.4% versus a 70% in 2019. And in phase 3, it was a 60% versus a 67% in 2019. So between 6 to 8% lower voter turnout has been seen in all three phases. Now, the next logical question is why, and why does it matter? So as to the why, could be a variety of reasons. One key one possibly is that we're currently going through a heat wave in a lot of the seats that have gone to voting. Temperatures have been above 40 degrees. So that pretty much cuts out, the number of people willing to stand in line between, say, an 11 a.m. till about a 4 p.m. So the number of hours where you can bear to stand in line and vote becomes lesser. Perhaps that's something that the Election Commission could have thought about or made alternate arrangements. But that's a theoretical discussion right now. Now, the question is, does low voter turnout impact election results? And here is where it gets important. And this is really where the big question mark comes. Now, historically, at least for the BJP, of the 5 times they have come to power, 4 times have been on the back of higher voter turnouts. So does that mean if it's a lower voter turnout, it spoils the chances of a policy continuity or of any one party coming to power? There is no clear data linkage which could bring you to this conclusion, because what matters at the end of the day is of every 100 people who come to vote, which party manages to get its supporters to the booth. And that's something that we'll have to all see on the 4th of June. So difficult to predict that right now. The other big question, and guys, I want your view on this as well, is this whole thing in the market right now that is 400 par becoming 320 par. My point is that for any kind of policy continuity or to run a government effectively or to make decisions, because at the end of the day, that's what matters to people, investors, etc., you need 273. So does that 400, 320 or any figure above 273 actually matter in real terms to any outcome?
Yeah.
Is the question.
So I think most market participants are saying that if there is a disappointment, if the voter if the actual outcome is not 400 par, but let's say sub 350 or whatever the number might be, most people have to say that even if there is a disappointment, it might last for a day or two, because the markets are aligned to the fact that there is political continuity, and that is what effectively matters, which is what you're saying.
Does that also mean policy continuity?
You could argue
as much
right?
ease?
Yeah, I mean,
absolutely. Let me give you an example. The Narasimha Rao government didn't even have 272
and
by
still
itself.
Managed to push for everything.
So before 2014, you have had in India successive coalition governments who have done whatever they needed to do. So your 1991 reforms, etc., were all coalition governments. You need 273 to run a government. And then the rest is just a plus. So a vanity figure or a political slogan does not, in effective terms, translate to what you can do when you're sitting in government. So.
Yeah, well, that's, I guess, what is most important, right? It doesn't really mean very much apart from just the fact that it doesn't sound as great, 400 versus 270. But a couple of other things that potentially, which is beyond elections, that could have seen a little bit of pressure on the street. And this, of course, are reports based that we are seeing. What you did have last month was India amending its double tax avoidance agreement with Mauritius. That led to a little bit of pressure coming in, which led to FI selling. What we also know that Luxembourg domiciled funds have sold Indian equity to the tune of $256 million. You're also seeing a slowdown in inflows coming in from the US and Japan. So while Luxembourg is Europe, US and Japan is seeing slower inflows. A delayed rate cut from the US has also meant that emerging markets like India historically have suffered. What we've also noticed from EPFR data is that the funds in India that have seen an inflow have largely been ETFs. So that is one more thing you want to keep in mind. The broader market stocks have been the flavor for DIIs, and that continues to remain the trend. But foreigner selling has been backed by the fact that you've got higher rates in the US, you've got valuations that one may argue are on the higher side. The 12-month forward P of the Nifty stands at 19.3 times, which is still at a 5% discount from record highs. Nifty 50 valuations, while look good, the broader market stocks look extremely expensive, and the expensiveness is being inversely proportional to capitalization, quality, and risk. And some are unhinged. That's what analysts like Lara believe from fundamentals and reality, and are entirely based on optimistic assumptions, wrong valuation methodologies, and unrealistic narratives. This I'm quoting Elara, and this is what they've actually put out in the report, saying these are some of the worries that the street is probably dealing with. But the fact remains we are priced to perfection, so anything that the markets would want to get nervous about, they're choosing to get nervous about, and that really is what's happening. For now, the WIX, like we've already indicated, is spiking, but we'll talk about what that WIX spike really means on the other side as Agam will join in on the FNO spotlight.
Welcome back to India Market Open, where we take a look at how things have panned out in yesterday's day of trade. Well, it's been an interesting couple of days. While we do see weakness coming through, there's been a lot of choppiness, and yesterday as well, we saw the Nifty come off by around 0.6%. Of course, at one point in time, it was down all the way to by around 1%. And we have a lot of long unwinding as far as futures are concerned, indicated by open interest decline of around nearly 4%. In terms of the Bank Nifty, even as the index came off by a whopping 1.3%, on account of a lot of weakness in ICICI, Axis and HDFC Bank, we saw more longs building in, indicated by an increase of nearly 7% in the May futures open interest. To take a look at the options market now, again, we naturally, perhaps on expected lines, did see a lot of writing on the higher level calls that would be somewhere around 22,400, 22,500, even as the index came off and parked somewhere around 22,300. But in terms of your overall open interest distribution picture, Now the range has sort of moved lower at the moment. We are seeing max open interest in calls shifting from 23,000 to 22,500, and on the lower end, when it comes to puts, that remains at the 22,000 strike. As far as the Bank Nifty is concerned, we've once again been unsuccessful in seeing it sustain above 49,000. We've seen Bank Nifty give up on that particular level, and we've also seen a lot more writing around that particular call. And of course, on the lower end, we continue to see a lot of accumulation in puts around the 48,000 mark. Well, moving on, as far as stocks are concerned, naturally a lot of that traction was in what we saw because of earnings. So Lupin and SRF looking at a lot of shorts, Voltas as well as in comparison. Godrej Consumer and Britannia, well, among the few counters which in fact saw a lot of longs, and FMCG was that one pocket in the green in a sea of red otherwise. Of course, in terms of stocks which saw unwinding, we saw a lot of short covering for HUL. Godrej Properties, Coromandel, Havells and Oracle Financial Services, on the other hand, looking at a long unwinding. But let's take this conversation forward and get in an expert on what they make of market conditions at the moment and how they are, in fact, deploying option strategies here. Well, we have Amit Goel of Amit Ventures who's joining us on the show. Amit, good morning. Thank you so much for joining in. Your view on the benchmarks as usual and what you're doing with options here.
Yeah, hi, good morning, Agam, and good morning to all your viewers. Nifty has, the benchmarks have been a little jittery. We have corrected about 2.5 to 3.5% in the last few trading sessions. Nifty has, I'm a little more concerned on Nifty because of the chart pattern. It has created something what I would call a double top sort of a formation. And it has risen from a double bottom formation a few weeks back. So what I see is Nifty is kind of in a range bound, and it really is fairly justified, because until we cross over with the event, with the general elections results, and then we settle into back to business mode, I think that we would probably be ranging in this market with a little bit of bearish bias. So Nifty, I'm a little concerned. Till we cross the 22,800 mark, I don't really see any strong traction here. But if there is any dip to around 22,000, 21,900, from where it has taken a support last time round, so I would probably look at building some long positions. But the general advice would be till the elections get over, traders should be a little light on the positions.
All right. So Amit, what kind of option structure are you deploying? I believe you do have one on the Bank Nifty.
Yeah. So since I am a SEBI registered RA, I am not allowed to give views or trade setups in Nifty since I carry them in my books. But Bank Nifty, yes, I can do that. Bank Nifty also is more structurally weak. The latest RBI circular has also not helped matters. We have seen some good profit booking in strong counters, in structurally strong counters like ICICI Bank, Axis Bank, and dare I say HDFC Bank as well. Kotak has also not helped matters, right? So structurally speaking, Bank Nifty has been weak, and I see a lot of call writing happening at near-term high levels. The numbers like 49,000, 49,500 seem to be near-term resistances. Bank Nifty is also again in a structural up move. The impulse move is up, whereas the corrective moves have been fairly deep. If I were to draw use the analogy of a Fibonacci number, Nifty has been taking support at around the crucial mark of 62%, whereas Bank Nifty has been deep diving around 78%. So I believe I'm a little structurally bearish on Bank Nifty, but considering that, again, because we might be in a range-bound movement, for the next week, I propose to set up a bearish short strangle, wherein we could look at, traders could look at selling 49,500 call of the 15th May expiry, and the 46,500 put can also be sold for the same 15th May expiry. This will yield you about 2,500 rupees as max profit. We will keep a rupee stop loss of about 2,000, 2,500 rupees. I generally advise that you should have a hedge position, as in you could buy the offsets. But since I have taken a very wide range short strangle with a bearish bias, buying a hedge here would really not would not leave you much meat in the game, right? So either you go for a short strangle or avoid taking this trade. Another advice for all the traders would be to avoid the same week expiry trades like today or tomorrow. Simply because the intraday volatility has been on the up move, and your stop losses could get hurt and there could be a lot of whipsaws. So ideally, you would want to trade the next week's expiry just to be a little safe.
Enough. A good point being made out there as far as Amit, from Amit, of course, because the kind of choppiness and a small sharp move, in fact, can take your stop loss out, and eventually you'd still perhaps realize that you would have eventually made a lot of money. But those sharp, moves eventually take you out of the game, and they leave you psychologically not in the best position often times. But Amit, we move on to talk about the FMCG space as well, the sector in general out there, and what we've seen is a lot of traction there. But I believe you have one of those counters on your radar as well.
Yeah, FMCG has been the darling of the market yesterday, right? We have had a very sharp move in all the FMCG counters, with as high as 10% to as low as 2% positive on a down day of the broad indices. Given the structural make of the market, I would want to play a little contra trade here. I am looking at Hindustan Unilever. It was up yesterday by 2%. It has given a smart up move. But I am trying to play the contrarian view here, because what I believe is a retail trader would probably be best off by trying to do some contra trades to supplement their breakout and momentum trades as well. So what I see on the weekly chart of Hindustan Unilever is with this up move, it is now coming closer to a weekly resistance zone. Okay, it has been structurally on the down moves in the entire year of 2024, and around 2,400, 2,430 is where I would see some bit of resistance building up in this. If you look at the open interest chart also, the 2,400 calls have witnessed a lot of call writing yesterday in spite of the up move. So I believe there is a lot of resistance building up at 2,400 levels. So what one could look to do here is one could set up a put ratio front spread in which we would look to sell the 2,200 put 2 lots of May expiry, and we buy 1 lot of 2,300 put. This structure needs to be put up in such a way wherein you end up making a net credit. Okay, so if there is continuation in this momentum and there is a lot of traction getting built up in Hindustan Unilever, you will not end up making any losses on the upside. The upside losses are completely protected. But if we are able to get the contra view right and we are able to pin 2,200 around expiry, this is a fairly swing trade. We should end up with very, very good profits. Again, I will still look at about 2,500 to 3,000 rupees as my initial profit target, and I will trail from there. That's the view on Hindustan Unilever.
Okay, so an interesting strategy coming in and being played for Hindustan Unilever as well. On that note, Amit, taking a moment to thank you for joining us and taking us through your views in the markets, and of course giving us a handful of option structures to deploy in these markets. With that, it's over to you, Tamanna.
All right, thank you so much for that, Agam. Nirav Ashar with us this morning, the head equity research analyst at Latin Manharlal Securities. Nirav, very good morning to you. We're also going to be speaking with Aditya Arora, founder and multi-asset research analyst at adleytick.in. Nirav, let's really begin with the FMCG pack, and there was a mention of that from our F&O expert as well. The question is that can the momentum continue? There is some positive sort of data coming in from Nielsen for the last month. And what the companies are talking about is an uptick at the end of Q4, positive commentary coming in. Do you think there's enough there really to justify the kind of optimism we've seen?
Yeah, good morning and thank you for having me on your show. Yes, in the case of FMCG companies, what has been happening is that the sector has been struggling. After COVID, we've seen a lot of issues, inventory-related issues, demand-related issues, and recently, of late, of course, they've been struggling with a subdued rural demand, and volume growth has been quite subdued. And what has been happening is that the sector as a whole has been saying that volume growth has been evasive. And I think the realization growth has also been kind of exhausted. So I think it was a tough situation for the FMCG sector, but hopefully now, if one were to see the results and the commentary which has been coming in from companies like Dabur, Marico, Britannia, etc., then I think most of these companies seem to be confident that the worst seems to be over. The raw material prices have stabilized, and we are seeing the rural demand making a comeback. So green shoots of recovery are definitely visible as far as the rural economy is concerned. So I think whatever happens, of course, will still depend on how things play out post the elections, and of course the outcome of the monsoons. Monsoon this year is expected to be quite normal, and I think that the kind of heat wave conditions which we have seen definitely point out that we are going to have a normal monsoon. So I think would be tempted to believe that the worst is over. And fortunately, what has happened is that most of these FMCG companies, they have used this lean period to ramp up their distribution structure in the rural areas, etc. So as Dabur rightly pointed out, that ahead of the curve investments will help these companies to perform better in the times to come. So I think definitely we can expect some recovery to happen from Q1.
We also have with us Aditya Arora joining in with a technical view on the markets. Aditya, what about you? Any long trades on the FMCG pack after yesterday's sharp move?
A very good morning to you and very good morning to everyone. Absolutely, I think the steam is still left in FMCG basket. After all, it's running after a very long time. So we have seen underperformance across the board for a very long time. I think it has been 2 years since FMCG is underperforming. Now this is the first day of the rally as per the charts, and I think there's a long way to go. So I would like to go with Marico. The momentum is good, the chart structure is good, derivatives data is good. Marico could be bought at 583.50, stop loss must be 559, and target would be 605.
Aditya, good morning. Just wanted to know your top picks.
So my top pick was Marico itself. So I would suggest a bullish
even
pick.
now, after the 8-9% run up yesterday?
Absolutely. As I said, this is the starting of the rally in FMCG basket. So there's a long way to go.
Okay. What about Dr. Reddy's? Aditya, just quickly want to get your take on Dr. Reddy's. The numbers out, and of course we'll get an assessment from Nirav on how he sees the numbers. But on the charts, do you see any potential for a breakout here, or is it going to have a down day?
As per the ADR, it was down about 4% yesterday. So probably 6,000 could be a good level to accumulate the stock. Although after election, stock could behave erratically. So one must wait for the stock to stabilize. But going by the level, 6,000 is a good level to accumulate. And if that happens, so then we can see 100 to 200 points of bounce from there.
Nirav, your take on Dr. Reddy's? Concerns about the amount they're spending on R&D, concerns about what happens post 27, FY27. How do you look at the numbers?
I think spending on R&D is always a positive aspect. Of course, some people might read it as being over-aggressive. But I think overall, if one were to look at Dr. Reddy's or even other pharma companies, I think their India-centric performance has been pretty good. I think it's the overseas performance which has been a laggard. So I think overall still feel that in the short term there is going to be some bearishness as far as the pharma sector is concerned.
Okay. Well, speaking of Dr. Reddy's, by the way, it's planning to launch 20 to 25 new products in the US market, as per the company's branded market CEO for India and EMs, MV Ramanna, while speaking to my colleague Sajid Pangat. Here out.
US business, the base business continues to do well. We are seeing the volume traction over there, and we have launched products in FY24, and we said that we expect to launch on an average of 20 to 25 products every year in the US, when we expect to launch new products in the US in FY25 as well. Generic Revlimid has been an important growth driver for us in FY24, which will continue to be meaningful in FY25 as well. On top of our generic business, we are building two other levers of growth over there. One is biosimilars, and the second one is consumer health. In the consumer health, we have a few initiatives going over there. Recently, we acquired Labs, which is in the women's health portfolio, and we're getting ready to launch our biosimilars. And on the biosimilars front, we will work not only with our own portfolio, and we will also look for inorganic opportunities to get access to the portfolio.
Okay, lots of other stocks which are in news this morning. We mentioned some of them, PB Fintech, there is, of course, Navin Fluorine as well. And Nirav, come in on specialty chemicals, but particularly these two stocks. Did you get a chance to look at the SRF numbers? The stock was down yesterday. And did you get a chance to look at the Navin Fluorine numbers which came out post-market hours yesterday?
Yeah, so definitely with respect to SRF, there was an expectation that the chemicals business is likely to perform better. There's going to be an improvement in the chemicals business. As we all know, they have three divisions. One is specialty chemicals, the second is packaging films, and the third is technical textiles. Now, unfortunately, all these divisions have been down under the weather, and we've not seen very good performances. We've seen the bottom line under pressure, revenues have declined. But there was a hope that specialty chemicals might turn the corner in this particular quarter, but this has not happened. We've seen some excess capacities in China, and they have put a lot of pressure on prices. There's been a lot of dumping related issues. So I think the performance of the chemicals division has disappointed. Secondly, of course, in BOPP films and BOPET, also we've seen some amount of overcapacity. And I think, again, the Chinese dumping has impacted over there too. Technical textiles also has been under some sort of pressure. So overall, I think still disappointment written all over as far as the results are concerned. I think we'll have to wait for another couple of quarters before we see some meaningful recovery in SRF.
Just one quick follow-up. What about Navin Fluorine very quickly, Nirav?
I think a similar kind of scenario would be there in Navin Fluorine too, because I think chemical space still, I think we still not out of the woods. So I think there will be some pressure on the stock as well.
Let's extend that conversation into two more stocks. Archean Chemicals, because I believe that business seems a lot more exciting than the other chemical, specialty chemical names, and Aarti Industries. If you can just give me a view on those two, because those are the standout guys in the chemical business.
I have not seen Archean, but Aarti Industries is definitely looking good. I think trying to make a recovery. So I think, of course, one can have a positive view as far as Aarti Industries is concerned. Right. And we've also seen Deepak Nitrite also. So I think that is also looking quite good. So one has to be very selective in this space.
All right, some more stocks that you should keep on your radar this morning. My colleague Kanika is joining us for more on that. She's talking about Tata, Elxsi, LTI, Mindtree and more. Yes, Kanika?
Good morning, Tamanna. So the first stock is Tata Elxsi, like you mentioned. Now, the company has collaborated with ARM, which is a British semiconductor and software design company. Now, this collaboration will mainly offer advanced solutions on the latest ARM processors, And this will in turn help automotive OEMs and tier 1s to fast track their transition to software defined vehicles. The second stock on my list is LTI Mindtree, where the company and IBM are to set up global joint generative AI center of excellence in India. Now they will mainly be combining LTI Mindtree's expertise in data and machine learning model customization along with its full stack engineering. This will be combined with the IBM Watson X technology. Now the idea here is that open innovation will be driving the growth of enterprise AI technology. Now the third stock on my list is Dixon Tech, where the company's arm, which is Dixon Electro Appliances, entered into a pact with Nokia. Now, this pact is mainly for development and manufacturing of telecom products. Now, manufacturing will take place at Dixon Electro Appliances manufacturing plant in Noida in Uttar Pradesh. Now, the fourth stock on my list is Mahindra & Mahindra, where NCLT has approved the merger of arms, that is Mahindra Heavy Engines, Mahindra Two-Wheelers and Tringo.com with the company. Now, upon the merger becoming effective, the company has said that no shares of the company will be allotted in exchange of the holding of the company in any of the arms. Now, the company also believes that the merger will lead to reduction in operating and administrative costs, along with the reduction in number of companies, which will help in ease of management. And the final stock on my list is Patel Engineering, where the company with its joint venture partner has emerged as the lowest bidder for an irrigation project. Now, the project is for the construction of water lifting arrangement work from submergence of Jilgaon project in the state of Maharashtra, and the project contract is worth rupees 343 crore, where Patel Engineering share amounts to almost 35%, which is almost 120 crore.
Those are all the stocks you want to track as we gear up for trade this morning. Aditya, very quickly, any sort of bounce back across the banking names? Would you consider an intraday long trade for banks today?
I wouldn't go long on banking names today, although there could be little, retracement. But overall, the trend seems weak for this week. So I would avoid longs in banking space. But on contrary, IT looks strong, so one could consider IT for going long.
Well, it's defensive trade, like Aditya mentioned. Stocks in the pharma pack, IT could be once again seeing some gains, including FMCG. We'll take a break. We'll come back, track pre-open trade, and of course gear up for another volatile day of trade.
Back with India Market Open right here on NDTV Profit in minutes from now. Of course, 30 seconds, the markets will kickstart. At least the pre-open rates will kickstart. As the implied open suggests that we'll have a flattish start, which is welcome. Let's just wait and watch if the sentiment dips a little bit post that or no. Of course, we'll talk about autos because if you look at this earnings season as well, if there is one bucket that has actually had a really good run in terms of earnings reportage, amongst a few, of course, but one of them is autos. The auto numbers thus far has held out very well. I think it's merit in trying and figuring out how would the sales continue. For now, the rates all over the place. Let's come back to these once they settle down a little bit. Nirav, any auto or auto ancillary names today? Bharat Forge reports and post what they did the last quarter. I think all eyes will be out on the commentary that they have to give about what happens in the year ahead. But anything in the auto ancillary space that has stood out in terms of results for you?
As far as the numbers are concerned, I think we've had pretty decent numbers, and I think we've seen very strong performance coming in from the two-wheeler pack. So I think should get reflected in the quarterly results also. As we await a few quarterly results for the two-wheeler pack, I think this space should particularly do quite well. And as far as the auto ancillaries is concerned, I think it's going to be an exciting year for Bharat Forge as the company is going to get. It's going to be a very important year because of the focus on various sectors like defense, aerospace, etc. And the kind of commentary which they are going to give with respect to get to all these verticals.
I want to come in. Nirav, can you hear me?
Yeah.
Nirav, I want to ask you, I heard you say that Bharat Forge could have an exciting year. In the quarter gone by, they have come out and said that they believe that the revenues and the prospects are looking very bleak. So why do you think that it's going to be exciting for them?
Because they've done a lot of work as far as this aerospace industry is concerned or the defense space is concerned. So I think their order book position should pick up from here. And they have said very specifically that this is going to be an important year as the company is going to graduate from tonnage to technology. And of course, they've been working quite a lot on these areas. So I think things should begin to look up from here.
Let's talk auto. Manish Raj Singhania, President of FADA, the Federation of Dealers, is with us on the show this morning. Mr. Singhania, very good morning to you. Just looking at the first cut of the numbers that you've put out, the association has put out for April, where retail auto sales have grown 27% year on year. Two-wheeler retail sales are up by 33%, three-wheelers up 9%, and car retail sales 16%. What is sort of the overview you are seeing, and give us a sense of inventory levels, even as we see these sales pick up on a year-on-year basis?
So overall, auto retails have been pretty good for the month of April, and we had a rocking start for the financial year. Primarily, you can attribute that we had the Navratras during the April month and plus the marriage season. All these contributed to the heavy buying that we get to see across the segment. The best part is two-wheeler continues to perform well. We are seeing a good growth of almost 33% in two-wheeler segment. That post-festival season, we have been seeing continuous growth in two-wheeler segment, which was lagging behind. Plus, with the new launches and new attraction and good schemes for the customers, the PV segment has also responded well. The contribution is now also coming from the rural market, which was lagging behind. Initially, the rural market was not contributing to the overall sales, and dealers in those areas in that segment were and products in that segment were lagging behind. But post Diwali and festival seasons, we have been seeing a continuous growth there. So that's a good part, and we anticipate with the good monsoon anticipated in this financial year, and also the good Rabi crop we had, and plus the good wheat crop we had. All these has contributed well for the auto industry.
Follow up on the point on inventory levels, Mr. Singhania, in two-wheelers and in passenger vehicles. What are the kind of inventory levels that you're seeing?
So inventory levels have been on a two-wheeler, it's on a very comfortable level, around 10 to 15 days.
Okay.
Four-wheelers, the inventory level continues to hover around 45 days. We do ask for an inventory level of 30 days. But looking to the planning of dealers for the Navratra and good auspicious days, the dealers definitely would have built up stocks before in the start of April, which would have been realized, during the month of April. The inventory levels right now is at a comfortable level, but the ask is still for 30 days.
Right. So, Singhania, a couple of other factors that pose as a challenge in the last few months has been supply side concerns. There are some constraints which I believe have complicated the landscape, especially in the PV segment. I'm quoting, this is what you had said last month. Do you feel like that's easing out? And also there was some election-related deferrals that we had seen or are seeing in the current months. Do you feel like all of this will actually mean that going into the next couple of months, growth will actually escalate further?
Definitely, during election time, we see a dip in high ticket size products, especially in PV segment. The two-wheeler continues to perform well, but yes, in PV segment, we definitely see election hampers the sale of PV vehicles because, carrying cash and there's a lot of obstruction in carrying cash and handling cash. So consumers tend to avoid going out to dealership or carrying cash during these months. Post-festival season, post-election season, during last Vidhan Sabha elections also, we have seen a high growth post-elections, and that's what we are seeing in these states also where the elections are getting over. We are seeing a jump in those states where polling has completed. So definitely we can anticipate a high, good growth especially in PV segment post-elections.
For me to assume that you're building your inventory ahead of that because you're now 3 to 4 weeks away from the final day, and I'm assuming post that the pickup will be obvious on the street. Also, one last question. In your opinion, over the next 2 quarters, which segment is going to lead growth for you? So what are you building up and betting most on for the next couple of quarters?
So we are betting best on is the rural segment. That was a segment which has been lagging behind what we should say the Bharat of India. Till now, post-COVID, that segment was really lagging behind, and dealers and our outlets in rural markets were definitely struggling. But we are really seeing that growth now coming in and retails happening in this segment. The entry-level two-wheelers have started performing well. We are anticipating the same thing maybe next year for the entry-level passenger cars. So demand is definitely there because mobility is an essential part in rural segment. It's the need of the people in rural segment, but due to the constraint in finances and high vehicle prices, all these have definitely mellowed down the retails in rural market. But with good monsoon, good crop, good quality and quantity of crop, we'll definitely see a good moment there.
Very lastly, Manish, in the rural segment, which is the product, if you can help me with that? Is it three-wheelers, two-wheelers, PVs? Where is your big bet? And I'm going to follow this up next month and ask you.
So three-wheelers it has been overtaken by the EV story. It has almost 55% penetration is of electric vehicle. But you can definitely bet on the two-wheeler market. The kind of growth and huge growth that we are seeing in two-wheeler segment, I think that will continue to perform well, because when the revival really happens, it is the two-wheeler market that will get initial benefits. And thereafter, after settling down and that aspiration of people of buying that initial product or the required product is settled down, then they will go for aspirational products, that is passenger car. So yes, two-wheeler will continue to perform very highly in coming months.
All right, thank you so much, Mr. Sangania. Great to speak with you. We'll see how the auto pack does today. Remember, Bajaj Auto was one of your top losers yesterday, but rural demand is picking up. That's the word coming in from the Dealers Association. Aditya Arora and Nirav Shah are with us. Aditya, quick last calls after the pre-open rates have closed. You're looking at a weaker sort of opening. At least as far as pre-open is concerned. Just wanted to, get your take on. Let's go back to your BPCLs and HPCLs. You had a pretty good uptake in the last couple of trading sessions on the hope of bonus share. 9th May is their meeting. Is that something that you'd bet on right now, Aditya? You're on mute.
Yes, I think petroleum, oil and gas space is buzzing since a while, and even yesterday's downfall, we saw outperformance of oil and gas space. So HPCL is a good candidate right now, currently trading at 519 with pre-opening rate. This could be accumulated at current levels, and stop loss must be 510, and target would be 530 to 540.
Okay. Well, the pre-open rates are looking wobbly for a lot of stocks which are reacting to results or news developments. Now, I don't know why IPCA is down. I've missed the news piece there. But Sonata Software is down 13% post the numbers. And remember on the trade setup, we spoke about these numbers being way lower than what the Bloomberg estimates were. So clearly one stock that is standing out. No, I'm talking about Sonata Software, yes. So keep that in mind. And Voltas is the other one, 7.5% lower post its numbers. Nirav, either of these two stocks, were you able to look at the numbers?
Yeah, I think Voltas was, we saw an uptick on the revenue side, but I think on the bottom line there has been a miss. But overall, I think still the commentary was quite good as far as the unitary products sale is concerned. So I think we should see some recovery in the stock going forward, because the outlook seems to be quite strong going forward for this piece.
But 8% lower today on that earnings miss for Voltas. So keep that one in mind. And Sonata Software down 13% as well. By the way, Pharma is the other one.
Even Dr. Reddy's 2.5%.
And IPCA, and Torrent Pharma, and AstraZeneca.
Look at HCL Tech. Let's just pull up HCL Tech very quickly and see if it's held up after the first pre-open burst. No, can't see anything much there, but it was doing fairly well. They have a tie-up with IBM. They're going to set up AI excellence centers in
even LTI Mindtree today
India
has mentioned this.
Even LTI Mindtree?
LTI Mindtree has mentioned that they are setting up an excellence center with IBM.
Maybe this is a new sort of a whatever. Everyone wants to get in on the AI bandwagon. But I was looking at IT also, because IT has had a couple of decent days of a run. And will that really continue is the big question. You're seeing a bit of selling pressure here. I want to quickly just pull up all of your FMCG pack. I saw a bit of selling pressure, at least in pre-open session in a Britannia, a Marico. Let's look at it, HUL and ITC, and see what they are doing this morning. And you might see a bit of pressure coming in there as well. Aditya, last calls, just about 2 minutes to go to pre-open. Anything that you would look at this morning? Are you still sticking with Marico, adding anything to that list?
I think Marico definitely looks good. It's not going anywhere. No deductions over there in the opening. I think GAIL is also a good candidate. Oil and gas space could outperform today. So one can add GAIL today at 195. Stop loss must be 190, and target would be 200 to 205.
That's the view on Gas Authority of India. Viewers, keep in mind for all the pharma names, actually, just before we go to market open, maybe just one quick call on the pharma stocks, because all of them have started off low. Aditya, between an IPCA, AstraZeneca, Dr. Reddy's, and multiple others which have started off low, which one looks weak on the charts for a fresh trade?
On the short side, I think AstraZeneca was showing good downside. That is about 8% in the open. So that is a clear avoid right now. And on future space, I think one shouldn't go short straight away, because the charts of Nifty Pharma Index isn't so bearish. So I would actually wait for the opening and look for buying opportunity in FNO counters, and I would avoid AstraZeneca for going long right now.
Avoid AstraZeneca for going long right now. In FNO counters, the charts look strong. So that is Aditya's view. We'll take in a further view from both Aditya as well as Niraj Shah post the market open. But keep in mind, pharma stocks are not starting off on a good footing. The index itself, despite the implied open showing that slight uptick, whatever, is not exactly going to set the stage on fire. So that's the second point to keep in mind. And keep an eye out for some of those result reactions. So Dr. Reddy's is one, Sonata Software is one, Voltas is one, and a few others that we have got to keep in mind. So a clutch of stocks in focus, but here's how the benchmark indices are starting off this Wednesday morning. We're starting off about 0.25% lower, nothing too untoward, but in the red, following some of the other Asian markets as well. Nifty Bank about 0.25% lower, so that looks, in line. Mid caps about 1/3%, and small caps too in the red. So it's a red screen all over. Suffice to say, the breadth would not be positive. Let's get the heat map up on the screen and show what's happening on the large caps. At least a clutch of red, very little green. Well, BPCL up about 0.5%. Coal India, SBI, ITC, but very, very few to really take note of per se in the session today. Maybe a bit more green now than when it immediately happened, but the index itself is about 0.3% lower. Now, what's correcting? Dr. Reddy's down 4% post results. The ADI was a giveaway. L&T about 1% lower. Ultratech about 1% lower. Grasim is about 1% lower as well. TCS less than 1%, but those are the top 10 losers, if you will. Not that IT is starting off very wobbly. So I think HDFC Bank is putting pressure because you see it in the top 10 losers. So that is slightly weak. Pharma names are looking weak because even Divi's is down in the red. And I don't know if FMCG is giving support today. Maybe ITC a little bit, but otherwise no. So on the flip side, Reliance is in the green, which is a good thing. SBI, ITC in the green, which is good. Maruti topping the charts, but Dr. Reddy's clearly taking it on the chin. But others like L&T, Asian Paints, etc. too. Building materials seem to be getting hit today. Tamanna, looks like Reddy's takes the cake.
Reddy stays weak, and you'll probably see a lot of red on the broader markets as well. So not a very, very, I would say, positive morning. The Nifty mid cap 150 about 0.5% down. Let's pull up the small cap index, also 0.5% down. So a bit of selling pressure there. Let me begin with the kind of moves you're seeing, and a lot of it result based. Big response and the big trigger right now is squarely on corporate results. So very little room to hide if your numbers aren't great. Jupiter Wagons, let's begin with that. Positive results, just about 2% up, and pretty decent numbers over there. Sonata Software is something which is hurting on the back of disappointing numbers, down about 12.5%. So if you've done well, it's a positively mild reaction, but if you've done badly, you're going to get hammered. Voltas perhaps also seeing that kind of a pain point, 8% down after results overhang. Dr. Reddy's we spoke about, but let's just revisit it because astonishing chart this morning, 4% because it's below estimate in terms of margins. Core margins at least are below estimates, and that's what's hurting the counter. Credit Access Grameen is the other one we should look at, and profits were decent. Net profit up 34%. That stock doing well this morning, 6.5%, 7% up. JSW Energy as well is one we look at. So as you can see, a lot of responses just purely to quarterly numbers coming in, perhaps with a lack of any other trigger right now in the market. So JSW Energy about 3% up. Just want to pull up Dixon as one, news sort of driver. They have a tie-up with Nokia, mildly positive, nothing too great happening there. These are some of the primary movers and shakers, but any other sort of theme that you're spotting this morning, Samina?
Tamanna. So look at Credit Access Grameen. Numbers were good. They might not have been great, but the market seems quite enthused with it. They've reported a profit jump of 34% to 397 crores. And I think the good news here is it comes in from core business and business expansion, on back of which you are seeing a big move on credit access. The stock is up 7% as we see it. Along with that, the few other names that are worth a mention, again, like I said, earnings reaction is Latent View Analytics, 4% up move on the counter. Again, good set of earnings from Latent View Analytics. Small company, but the movement is there. The stock is up 4%. IGL, 3.5% on back of earnings. JSW Energy on back of earnings. Spark, for a change, is not hitting up a circuit yet, but still trading positive, marginally positive, 2.5% higher. KEC, Just Style are some of the other gainers that we are seeing in trade. PFC, after a big fall, and REC, after a big fall in the first half of this week, is seeing some low-level buying. Both those counters are marginally higher. REC is up 0.5%. PFC, which was down 3.5% yesterday, trades the marginal gain this morning. Max Financial, now they reported numbers on the face of it that looked weak. They reported a massive loss versus a profit in the same quarter last year, but I believe maybe the core business is doing okay. That could be a one-off item. The stock gets a thumbs up, 2% higher. A pretty large block deal on Vodafone Idea is what we are getting in this morning, and the stock is up 2% on back of that deal. So you want to watch out for how Vodafone Idea is doing. The stock trades the marginal gain of 2%. Apart from that, what else am I picking up on? KEC, like I said, Bank of Baroda is seeing some low-level buying after big falls that these stocks have seen. Defense names like Mazgaon Docks, Cochin Shipyard, Garden Reach have also fallen quite sharply yesterday. This morning, finding their feet, marginal gains. Garden Reach, though, not doing too badly, trading with a slight positive bias. On the sell side, we've already highlighted Volta, Sonata, PB, Fintech, Pidilite, Jindal Saw. These all earnings reaction, trading with a very clear negative bias. 197 Communication still looks weak. You've also got United Breweries. Those numbers look phenomenal. I don't know why the stock is down 2%. We will understand, like I said, from the management, whether the gain came in from core business alone or was it an exceptional item that led to a big bump up. But from the way the stock is reacting, it could be beyond actual core business. Brigade Enterprise, 2% low. So real estate continues to have a bad day. Zomato continues to see some weakness. It's moved all the way down from 200 to 188 levels. Macrotech also down 2%. So all in all, real estate is a weak spot. The markets are still looking extremely jittery and nervous, and with a downside bias. So this is exactly what's played out in the last 2 days. Gap up, opening, and weakness. This morning, implied Nifty was giving us a little bit of hope, but the Wix is up another 3.5% as we see it, and that is discomforting.
10th day on a trot now for the Wix. So UBL, the EBITDA miss also might be playing a part, despite the fact that the PAT numbers look very solid, but the EBITDA miss might be something that might also be working on the minds of people. But just the way pharma has come off today is quite relevant. Actually, Nirav, let's come in on that point. UBL, Samina pointed it out, the results and the EBITDA miss there. What did you make of these numbers, and do they enthuse you, or is the EBITDA miss a sore point?
I think the revenue growth was quite impressive. So I think we'll go with that. The EBITDA miss, definitely, I think going forward, we will see an improvement in the bottom line also. But I think I would go with the revenue growth. It was quite impressive in this quarter.
So UBL, they're looking weak. I just want to quickly, Nirav, with you address the question on real estate. And we're going to have a more detailed chat in just a few minutes right now on the whole run-up in real estate and whether there are now concerns coming in on the profitability of the business, which of course has a long gestation period. Look at a Prestige this morning. Look at a Phoenix Mills, 2.5% down, just a day after a Knight Frank report about ghost malls coming up. Nirav, just, would you say that it's been an overbought kind of a sector right now and you expect cool off for a bit?
Some amount of profit booking is natural, but I think the best is yet to come. So I think the prospects look very, very strong. If one were to just look at the balance sheets of all these realty companies, the kind of response which they have been getting to their new projects, the kind of deleveraging with what they've been achieving on their balance sheet, I think the next couple of years look quite interesting as far as realty is concerned.
You looked at JSW Energy. Is it showing some signs of a breakout? The stock is up 6% as I see it at the day's high point. Volumes are also looking quite healthy here, 5% now.
looking very exciting. I think as we pointed out that power stocks continue to be in the limelight because the demand continues to be very, very strong. So not only JSW Energy, but I think even Adani Power is looking quite strong.
Did you look at Credit Access Grameen numbers? I know it's a small player, but numbers were good for no. You've got this big smile on your face, and I'm assuming that's a clear no on Credit Access Grameen. The stock is great. Markets, I guess it's a micro cap to say the least, but the street is getting excited. 40% growth on top line on back of business expansion is what is keeping it up and about. IGL is also up 4.5%. REC, PFC, Aditya, are you expecting this bounce back to continue on both those counters? Could be an opportune trade for a short pullback?
Yeah, I think now the downside and the bad news is properly priced in, and now stocks are poised, all these electricity counters are poised for a good rebound. So yes, one should go long in REC, currently trading at 518.20, and stop loss must be maintained at 480, and target would be 530 to 550. And I would also like to bring to your notice, GAIL, which was our opening trade, is up about 1%. So one could, trail the stop loss to 195 now.
Okay. Well, Gas Authority of India up 2.5% as well. FMCG starting to inch up a little bit, so that pocket to kept in mind. And today, one of the dailies in the open which mentioned about how the government will be reevaluating the norms that the RBI put out on PFC, REC a couple of days ago, because of which the stocks had taken a big beating. I think we're just seeing that uptick today. PFC is up 3%. REC, there's a con call going on as well, but REC too. I reckon this is not because of the con call, but because of the fact that those norms might be relooked. And if they are relooked, that earnings hit that was due to come will not come, which is why both these stocks are starting off well today. Fundamentally, Niraj Shah, if indeed some of these norms that the RBI had suggested are diluted or taken off, the growth story in power seems strong. Would REC, PFC become stocks that you could look at afresh?
Definitely, yes, because I think the power story is it's a long drawn story, and we are seeing so much thrust on renewables at this point in time. If one were to look at the thermal mix, it is around 57% of the capacity, and 42% is renewables. Going forward by 2032, it is expected that the same will reverse, and we'll have a share of 66% of the power flow coming in from the renewable space. So one can imagine the kind of investments which are going to go into the renewable space, and all this is going to be funded by the likes of REC Power Finance Corporation. So it's going to be a very, very exciting scenario going forward. And plus the Prime Minister's statements on Vikasit Bharat, especially with respect to renewable energy, I think they hold a lot of promise and potential.
Point on REC and PFC, a lot of clarity coming in from the con call that's probably helping. Just let's pull up the chart so far, not too much on that chart, but see how it's responding. Just the point that you were making, Niraj, the fact is that these were first of all proposed guidelines. The procedure is that whenever the RBI proposes something, it first now opens it up to all stakeholders, including government, other banks, REC, PFC, etc., public. Everyone can come in with their views. So the news story this morning that the government will look at it is something they would have done in any case. Do you think that after perhaps a beating down on the basis of draft guidelines, which weren't really real, now the fact that those draft guidelines may be looked at, which they would have anyway, the market is now overcompensating?
Yeah, because the market in its wisdom decided that these draft guidelines mean that the earnings will get hit and punish the stocks if those draft guidelines are getting diluted, if you will, because the story suggests that the government might actually, that there is opposition to these, and these might not come in the same shape and form. And if indeed the market believes that, okay, what was going out to be a possible punishment is not going to be, then therefore the reaction should be on the upside.
My point is a draft is a draft is a draft.
But the markets took the stocks down, so the markets are taking the stock up.
Yeah. So it's neither here. Actually, nothing happened. Actually, nothing happened either
the fall
way.
still has a long way to go to keep those losses. And I think IFL Securities put out a report saying for REC, PFC and IREDA. They expect no impact on return on equity, which is the ROE, but expect only their tier 1 ratio to be hit by 200 pips to 300 pips, and potentially that could weigh on valuation multiples if this becomes reality.
There was a Bernstein report, there was a CLSA report, all having different sets of figures. We spoke to IREDA yesterday, who said that no, skin off our nose.
It is just unfortunate that after REC reported such a stellar set of numbers, of course, these valuations talk about 20, 30 years ahead in terms of pricing. But one other stock, and Aditya, you come in on this one because I know before the big fall or the nervousness set into the markets, Tata Motors was a unanimous buy call on the charts. It was going through a breakout. The stock had been an underperformer. There was every and any reason given to why Tata Motors would have done well in the next few weeks. Contrary to that, the stock is sub 1,000 and it's been declining sharply. Now, does it still look good on the charts is what I want to understand, because I'm assuming a lot of short-term traders would have got stuck on Tata Motors in the last few days.
As you rightly pointed out, it was an consensus buy, and even on the derivatives front, a lot of call writers were active at 1,000 strike, which are still active, and also at 1,100 strike. So I think 1,000 to 1,100 is the supply zone for the stock, and no doubt that stock has seen stellar rally from almost 60, 70 levels to almost 1,100. Now probably a lot of smart investors are taking chip off the table, which I could see on the charts. A lot of volumes are seen on the declines. So a lot of people are taking chips off the table at these elevated levels. So as per the chart, I think now the candidate has turned to sell on rise, and there could be instances where stock could dip towards levels like 950 and 900.
Okay, that's the story on Tata Motors. I just want to revisit one of our top losers this morning in Dr. Reddy's and look at what's happening there. Not just Dr. Reddy's, Divi's as well, not doing too well. Let me pull up Lupin, Ipca Labs, a bit of pain point in the pharma sector, which was seeing a defensive and rotational play. Nirav, anything that you would bet on over here, or look at as a possible medium-term bet?
Well, at this point of time, I would like to stay away from pharma.
And avoid coming in on pharma. Nirav, what was your view on Tata Motors? I didn't get a chance to ask you that. On the charts, of course, it's got a lot of traders on the wrong side. But fundamentally, a good stock to buy at these levels at 988, what does it look like?
I think I'll wait for some more correction, maybe near 950 levels.
So 950 at Tata Motors, some more pressure cannot be ruled out. The stock is really looking flat as we see it right now. At its day's high point, but that's not much to cheer about, at least as we see it. Another theme, Nirav, that was, the big talking point on the street was some of these defensive names, which was seeing heavy buying across the month of March and April. Some were calling it election buying, some were just simply calling it a multi-year growth story. But the last couple of days could have given investors an opportunity to go in. So an HAL, a BDL, Cochin Shipyard, Garden Reach have all corrected sharply. Do you think the time is right? Those valuations are a little more compelling today than they were maybe a few weeks ago?
I think the market has been oscillating from extreme confidence, supreme confidence to now a kind of a pre-election jitters. So that is being reflected in all these stocks. So I think we expect that there's going to be some more correction in these stocks. So one has to wait for some more time because I think this nervousness is likely to persist in these defensive names also.
All right, we'll take a very short break at this point. Aditya and Nirav, thank you so much for speaking with us today. After the break, we set our sights on the real estate space. Now, the Nifty Realty Index is down second day in a row. A bit of profit booking there in a bunch of stocks that have run up massively. But what we're focusing on with our next guest is also the growth of ghost shopping malls in India. Why is this happening? What does it mean? Gulamji of Knight Frank with us on the other side.
back. You're watching India Market Open. That's another weak day of trade of sorts on D Street. Markets still struggling to find their feet, at least from the way we look at it. One sector that continues to have it rough is the real estate pack. There's still no relief coming in, despite the fact that some of these counters have sold off quite sharply over the last couple of days. Now, the question to ask is it basket selling, is it profit taking, or have things changed in terms of fundamentals? To understand that, Ghulam Zia, Senior Executive Director of Knight Frank India, joins in. Good morning, Mr. Zia. Hi, it's Samina joining in as well. The last time we spoke, we talked about your wealth report, which was very positive. This morning, of course, we've woken up to ghost malls, which we'll talk about in a minute. But I want to talk to you about what is happening in the real estate sector at this stage. I know luxury premium housing is at its peak. Things are looking great. A lot of the money made in the equity markets historically has always moved to real estate, which is also what's probably happening underway, which is currently happening underway. But the flip of it is, with better looking equity markets, does it mean affordable housing is not seeing the kind of traction the industry would have liked at this stage?
Well, the first aspect that we must all keep in mind is that of all the listed players, residential segment contributes almost 75 to 80% of their earnings. And that is the sector which has been doing extremely well, especially mid to upper end. And as you rightly said, the concern obviously is on the affordable market side. But then whatever said and done, even their main volumes come from mid to upper end. If you look at most of the listed players, barring a few of them who are focusing on mid to lower end, which is affordable housing, most of them focusing on the upper end. So the movements that you're talking about perhaps are not completely reflecting the realities on ground, where the transaction volumes are shooting up. In fact, at least in the month of April, and I'm looking at Mumbai data, the best ever April transactions we have seen in Mumbai. And that is a reflective or just a sample of the rest of the country as well, because even Bangalore, Delhi, all markets are doing superlatively performing. So residential market is absolutely in focus and it's doing extremely well. The concern you spoke about mid to lower end remains, because post the COVID concerns, the lowest segment of the industry was worst hit, and it is still taking time to come in. And the worst part was that the home loan interest rates have shot up so much, and those things are impacting a lot on the lower end of the market. So the first 100 days, some political parties are talking about bringing some special incentive for affordable housing, which we do see coming up in a couple of months. So that will bring even affordable housing back on track. So overall, residential market is absolutely in good health, pink of health. The commercial, a few of those listed players are focusing on office market as well. Even there, the first quarter was the historically best quarter for office market. So these are two sectors which most of your listed players are focusing on. And at least these two sectors, there is absolutely nothing to worry about. In fact, in times to come as well, we don't see anything changing soon.
Ghulam, hi, good morning. Tamanna here. I just want to understand in terms of profitability. Now, some things are established. There is continuing demand in the premium segment of residential real estate. Commercials not looking bad. Developers are acquiring more and more land bank and looking at a 5 to 10 year upcycle. The question then now comes on profitability. The biggest number that is being watched is pre-sales. I want to understand from your perspective, how fair an assessment you get on the health of a balance sheet with just pre-sales, because cost of funds is going up. Interest rates, like you said, is a bit of a lag. And that, in a sense, balances out the enthusiasm on the demand side, isn't it?
It does. It definitely does. The focus, if you're talking about profitability alone, you are right. A lot of these factors are, putting a pressure on the margins. But on the other side, the prices are also inching up. So net it is balancing out. The concern still remains that how long will it last in terms of the velocity of sales, etc. But as long as the prices are not going bonkers completely, we don't see much of a concern on the margins as well. You're right about many of these developers are buying land for future. That will obviously have an impact. And ultimately, your question about pre-sales, well, I'm not a very strong believer in pre-sale, because there is a lot of gap between the reality and what is happening on pre-sales, because lot of cancellations also happen in times to come. So while there is a lot of brouhaha about what is happening on pre-sale, people selling 500 apartments in 15 minutes, etc., we need to take it with a pinch of salt. But that said, velocity of sales is intact. Rest of all parameters are really in place to indicate a very sober market.
I mean, there are lots of pulls and pressures, and we're only at the start of the bull run across the real estate sector. Your Night Rank put out a report saying that they've seen a 238% increase in ghost shopping centers since 2022. And this is a number that for the retail or somebody, waking up and trying to understand what's happening is a little nerve-wracking, right? All this at a time when the Indian economy is booming, consumption is on the upside, it's urban and premium discretionary spending that's looking good. What does this mean? Why is this happening? Is it only online shopping that is replacing in-mall shopping? Or is there more to it than that catches the eye?
Well, at a very macro perspective, I would say that the reality remains that e-commerce is the biggest challenger for brick and mortar retailing. But that said, another few things are also to be looked upon, and a few of the major ones are that consumers, especially in the tier 1 city, are spoiled for choices. You need a certain lifestyle. When you're talking about a mall, you're talking about a lot more than just going there and shopping or consumption alone. It's a lifestyle, it's an experience. And that's exactly what we all have realized, that during COVID, when we were sitting at home and ordering stuff, what was missing was experience. So when we are coming back to malls, that's exactly what we are seeking. So the malls which are fulfilling all those requirements of giving you a certain lifestyle are the ones performing. So just to give you an indication, the malls which are doing well, which are almost about 47-48% of A-grade malls, are actually seeing less than 5% of vacancies, which means that the malls are almost full. There are people, the retailers are making beelines outside those malls to get into them and put their merchandise on display. So while a few of malls are really falling by the wayside because of lack of mall management or because of maybe physical infrastructure connecting them to the rest of the city, etc., is not falling in place, few malls are really falling by the wayside, but the ones who are doing well are doing exceptionally well.
How do you read into this very diverging data? So you're right, a Phoenix mall in Mumbai is buzzing, to say the least. But I'm sure there's a smaller mall in the outskirts of Delhi that doesn't see the same kind of traction. But let's also not forget that companies, smaller maybe, the likes of a Brigade, the likes of a Prestige, have been gung-ho about expanding their mall portfolio. Does that mean that they will take a step back and say, you know what, if the mall business should be left to the guys who know this, which is the likes of a Phoenix, or would they still continue expanding in that space? Because I'm assuming rental yields are also not going to be looking very good now.
Well, one thing which we must also keep in mind, as I said, it's all about experience. It's all about touch and feel. And for that, the new malls that are coming in are bringing in right technologies, bringing in right experiences. So the ones which we're talking about are essentially the ones who have really not reinvented themselves, who have been older ones and unable to do improvement in the service offering to the consumers. So those are a big concern. I would still not rule out the new entrants who are coming up with better technologies, better products, better experience and lifestyle would still do superlatively well. So it's not really, one answer fitting all. You need to look at them, each of those malls separately, because these are absolute different micro markets, different consumption patterns, different retailer grouping, etc. So I would still not believe that new mall managers coming on, or new developers coming on to the mall business would not do well. I'm sure with new entries, new malls, new brands, etc., they will be able to make a mark.
Okay, you have to take that in perspective of changing consumer habits as well, that you might go to a mall, sample something, come back home and then shop for it online. That will also sort of impact. But when you're saying ghost malls, that means footfalls are also being impacted. Thank you so much, Ghulam Zia, for speaking with us today. Always a pleasure. Hope to see you back on soon. Very short break, but on the other side, we bring you this conversation with Bank of America's Adarsh Sinha. He's talking about rate cut expectations from the US Fed and from the Reserve Bank of India. Stay tuned for that. won't they? That's been the biggest question mark in terms of a possible Fed rate cut in all of 2024. And over the last 5 months, the timing of that cut has moved from possibly in March to September to December, and now with the latest set of economic data coming out of the United States, maybe a slightly more positive outlook. But what is the scenario setting up to be right now? What does it mean for India's FX outlook? To talk about all of these things and more, I'm joined now by Adarsh Sinha. He's co-head of Asia FX and Rate Strategy at Bank of America. Mr. Sinha, thank you so much for speaking with us here at NDTV Profit. We're glad that you've taken out the time to talk with us today. So let me start with your take on where we are. In the last 7 or 8 days alone, there has been such a swing in sentiment on both the outlook for the American economy as well as the possibility of rate cuts, whether it's employment data changing, non-farm payroll data changing that mood. Earlier, it was GDP data changing that mood. Where is your assessment standing right now?
Sure, Tamanna. Thanks for having me. So you're right. Market pricing for the first Fed rate cut has shifted a lot. Initially, it was the CPI inflation data a few weeks ago that was higher than expected. And then more recently on Friday, of course, the jobs data was weaker than expected. So look, our view is that the first Fed rate cut happens in December after the US election. The market is currently pricing in just under 2 rate cuts by the end of the year. But I suspect the market will keep shifting between roughly around 1 to 2 rate cuts for 2024, leading up to important data releases. And I think the most important data release coming up now after the jobs report is the next CPI inflation print next week. So I think the jobs report was important in that it suggested a very important part of the US economy, the service sector, is slowing down. And a lot of the things that the Federal Reserve cares about, whether it's the consumer, the labor market, inflation, all of that is being driven by resilience in services. And you also had the ISM services index on Friday that was weaker than expected. So I think all of this is consistent with our view that the Federal Reserve will definitely not hike again. There was some discussion around rate hikes a couple of weeks back. That won't happen. And they'll probably cut rates this year. The reason we've gone with December rather than September is that we think it'll be a bit difficult for the Federal Reserve to cut rates too close to the US election, as well as the fact that base effects will become more positive for inflation in the second half of the year. So we think they probably need to wait until December to deliver that all-important first rate cut.
So what do you make, Mr. Sinha, of now polls? I think the last rating I saw was 66% saying there would be 2 rate cuts this year. Do you think that's just the optimism index this week and it will pare down depending on the next set of data?
Yeah, as I said, that's pretty much what the market is pricing in, 2 rate cuts, but I think that'll swing a lot. You just need a sticky inflation print next week for the market to move back to pricing in just 1 rate cut or maybe less. So as I said, I think we'll be in this 1 to 2 rate cut range. I think for the market to price in more than 2 rate cuts is going to be quite difficult, because for that, we need to see meaningful progress on inflation. And what that means is the Fed needs to be confident that core PC inflation is at 2.5%, close to 2.5%, and heading towards their target of 2%. And in my opinion, that seems unlikely over the next couple of months, at least. So I think we'll stay in this 1 to 2 rate cut range in terms of expectations, in terms of market pricing.
Just to come back to why you're penciling in December and what are the factors coming in, do you see inflation paring down to where the Fed wants it? Or do you see a more clear weakening of economic indicators for the US? Which one do you think is the penny that will drop?
So I think it's a combination of both, but I think inflation by its nature is sticky and often a lagging indicator. And I don't think the Fed needs to wait for inflation to come down to 2% to start cutting. So as I said, if core inflation, core PC to be precise, comes down to 2.5%, I think they'll be comfortable starting rate cuts. So I suspect what matters more and what is perhaps more of a forward-looking indicator is the actual growth numbers. And in terms of growth numbers, I would argue it's not even the labor market. The labor market tends to be a lagging indicator as well. So I would say it's forward-looking indicators like the ISM services, like consumer spending data on services. I think these growth numbers will probably be a bit more important in terms of giving Fed confidence in terms of their forward-looking forecasts on inflation. Yes, inflation needs to come lower, make no mistake, but I don't think they need to wait for inflation to get to 2%.
I want to now understand how you see that impacting, say, the Indian rupee. Are we going to expect, the sort of range of weakness we're seeing rupee dollar till at least December? What are the triggers there that you see?
Look, I mean, the FX market tends to be forward-looking, so the dollar's not going to weaken in December when the Fed cuts rates for the first time. So I think as long as the FX market has confidence that we're not that far away from a rate cut, then the dollar should start to weaken. And I suspect, and based on our forecast, we kind of think that starts to happen towards the end of the third quarter, and definitely in the fourth quarter, we do expect dollar depreciation. Until then, the dollar can remain at a strong level. But I think for dollar rupee, what's perhaps a bit more important than the direction of the dollar is obviously the Reserve Bank of India's reaction function. They have been one of the most active central banks in intervening the FX market on both sides, both selling dollars and buying dollars and accumulating reserves, and importantly, keeping FX volatility low. So the question really is, whatever dollar regime you're in, whether it's a strong dollar or a weak dollar regime, does that change the reaction function of the Reserve Bank of India? And our view is probably not. I think they've done quite well in terms of keeping FX volatility low. Heading to the election, FX volatility will probably remain low. And even after the election, we suspect they'll continue to keep volatility low as long as you don't see a big swing in the US dollar either way. However, by the end of the year, given that we do expect dollar depreciation, given that we do expect the euro to be at 1.12 versus the US dollar, I think that's an environment where they'll tolerate a slightly lower dollar rupee. So our forecast for the end of the year is 83, which is only slightly below where we are right now.
On that particular point about how responsive or reactive the Reserve Bank of India will be, and that's sort of the ongoing debate and conversation. Should or will the RBI wait for the Fed to act first? And is there enough of a case for the RBI to start cutting rates before the Fed moves? Do you have a take on that?
So frankly, it's a question that every central bank is asking. And it's interesting, even though we changed our Fed call to December, we haven't changed most of our other central bank calls for cuts, including India. So we still forecast the Reserve Bank of India to start cutting rates a few months before the Federal Reserve. But it's not just India. It's the European Central Bank, we think, will cut rates in June. The Bank of Korea will cut rates before the Fed. So I can go through a whole list of central banks that could potentially cut rates before the Fed. Now, the reason is that disinflationary dynamics are perhaps a bit more evident in countries outside the US. And output gaps are wider, growth is somewhat weaker. So it does kind of make sense that central banks might not have to wait until the Fed to start cutting rates. Now, the only exception to that is for countries where currency depreciation becomes a concern. So, if the currency is facing a lot of pressure and central banks are reluctant to cut rates, one central bank, Indonesia, actually hiked rates recently. So the currency can be a bit of a wild card, but I think in the case of India, dollar rupee has been quite stable, even during the risk off that we saw in April. And as long as the currency remains stable, we think the Reserve Bank of India could potentially, all else unchanged, start cutting rates a few months before the Federal Reserve.
Okay, so you could see rate cuts in India first. That's the take from Mr. Sinha. Thank you so much for joining us. Pleasure to have you on and hope to speak with you again soon.
Thank you very much for having me. Glad to be on.